The tax credit could be up to 65%, right? That $1 million potentially could come to me and I wouldn't pay a penny of personal taxes on it. I often discourage business owners from considering RSPs because this is really your RSP, right?
Any technology business owner in Canada will have to make a trade-off at some point if they're planning to raise capital. But then the question becomes, what about the taxes you pay on investments in that company? For us little Canadians, we're okay taking $10 million and living happily ever after. We pay very low corporate tax, particularly for small businesses, somewhere between 11 and 12%. Top marginal tax rate at 53%. We want to avoid paying that on a regular basis if we can. Thank you very much for being here today. My name is Brandon, and joining me today is Walter. Walter is an accountant that has helped a number of companies with setting up their business for successful exits. I'm a financial advisor and planner. Our goal today is to share with you some insights we've learned over the years. Walter will start with talking about some of the business structures that some of you may know, some of you may not. I'll then be talking about some strategies that you may look to leverage with your tech business. So without further ado, I'll pass the floor over to Mr. Walter Faucus.
Thanks, Brandon. Look forward to talking about some foundational items in tax and structuring your business. So the first slide, it shows there are other structures, but there's three common business structures. There's a sole proprietorship, there's a partnership, and a corporation. They all have differences, they all have pros and cons. But the starting point, we'll talk a little bit about a sole proprietorship. And a sole proprietorship would be, say I personally want to start a business. Maybe I'm an employee somewhere and I start a business on the side, so I would have employment income, and then I would also have my business income. And for sole proprietorship, there's no distinction legally or for tax purposes between me and that business that's a proprietorship. So there's no distinction. So they're taxed all under your personal return. And then if you contrast that with a corporation, if I incorporate a company, that corporation is distinct from me. It's a separate legal entity and it's taxed separately from me. So in my example, if I'm an employee, my employment income would be taxed on my personal return. But if I have business income in a corporation, it's taxed separately. So I'll just give a brief example of how that might play out to illustrate. But you're a sole proprietor, you have a business, you have $100,000 of employment income, and then you have $100,000 of business income. So on your personal return, you would actually have $200,000 of taxable income. To contrast that with the corporation, if you had incorporated, you would still have your $100,000 of employment income, which is taxed personally, but then the $100,000 of business income is taxed in the corporation. And then just to illustrate one other thing, because often, businesses in the first few years, they have losses. Let's just change the example to you have $100,000 of employment income and then $100,000 business loss. If you're in the proprietor's structure, your taxable income would be 100 minus 100. So you'd actually have zero personal taxes and zero taxable income personally. If you had incorporated, you'd have $100,000 employment income, and then you'd have $100,000 loss in the business. And the key point there is that there's no way to sort of move that loss in the company against your personal income. That loss, it's trapped in the corporation, and it can be used against future profits in the incorporated business. So just some thoughts when you think of structure, just think, are there going to be losses in the first few years, or is it going to be, immediately profitable? The other big thing, and this is more sort of focusing on businesses that are profitable, is there's a concept called tax deferral. And that is probably the most important tax planning opportunity business owners have. So what is tax deferral? Well, there's a few other things you could talk about. One is tax evasion. Tax evasion, it's illegal and you should not do that. There's tax savings where you do a transaction, you plan something, and you have sort of a permanent tax savings on a transaction. The other one is tax deferral. So the idea of tax deferral is that you pay as little tax as you can now, and then that after tax profit, it grows on a tax deferred basis, and then it gets taxed in the future. So with tax deferral, you're really paying low tax now, and then sort of deferring the taxes to a later date. So I'll just illustrate this once using a few numbers for a proprietorship versus a corporation. So some of you may know, but in Canada we're taxed at marginal rates personally. So the more money you make, the higher your tax bracket is on the next dollar, right? So for BC, the top tax bracket for personal is 53.5%, right? So if you make $100,000, 53,500 of that would go to your friends at CRA, right? So that's a pretty high cut of profits, right? So if you contrast that with a corporation, in a corporation there's a few different tax rates, but I'll just look at one of them, the small business limit. And a small business limit, the first $500,000 of corporate profits, it only gets taxed at just 11%. So you see on the one hand, 54% tax personally under proprietorship, 11% in the corporation. So the difference between 54% and 11%, it's over 40% deferral. So that's quite significant. And if you sort of thought of an example of $100,000 of profits, under proprietorship versus corporation, you're almost deferring $40,000 of taxes annually, and then that, savings, it sort of compounds and grows over time. So that tax deferral, that's for tax purposes, that's the key reason you'd want to incorporate. I won't talk much about partnerships or a flow-through entity, and they're generally used in real estate and a few other particular situations, but they're not too common. The other comment with corporations is, the corporation and the shareholder, they're separate legal entities, and so there's a border between the company and the individual. So if there's profits in the company and the shareholder wants to take them out, how do they come out? There's three basic ways. One is a wage, which we're probably all familiar with. The other is dividends, and dividends are after-tax corporate profits that come to you, and they have a lower tax rate than salaries. And then the third one is shareholder loans. And shareholder loans are really, if you finance a company or put your own money in, then when there's cash flow in the company, you can take it out without any personal tax consequences. So those would be the key structures and the key things. Obviously a corporation, there's a cost to maintain it annually and initially. In the proprietorship, the cost is lower. And a lot of these things you can often start with a proprietorship or a partnership, and then when the time is right and it makes sense, you can roll it into a corporation without triggering taxes. So I'll leave that for structures, and I'll flip to the next slide, which is scientific research and experimental development, which we refer to as SR&ED. And I bring this up because there's a lot of, tech companies that, make claims, SR&ED claims. And some of them may not be aware of it, but it's a very generous program set up by the government to encourage businesses to invest in research and development activities, right? And just to highlight, the tax credit could be up to 65%, right? So $100 of SR&ED expenses could get you back $65. So whenever I incorporate these SR&ED returns, I'm always just shocked how well it works out for the companies. Who will prepare it? You can be done internally, but often there's a complex narrative to it, so you might get an external consultant to help you with it. And then, it ties a little bit into shareholder compensation. If you're a shareholder and you're involved in SR&ED activities, you want to ensure that you have a decent wage to maximize your SR&ED refund. So just something to be aware. It can apply to technology companies, but also, companies looking for industrial advancements. The next slide talks about capital gains exemption, and I think it is by far the greatest tax planning incentive out there for business owners. So very simply, if I had a company that qualified and I sold you the shares of my company for $1 million, that $1 million potentially could come to me and I wouldn't pay a penny of personal taxes on it. So I get that $1 million tax-free. So that's about as good as they can get for exiting, right? And really that's the government's way of encouraging people to take on risks, try ideas, and create successful companies that are going to hire people, grow the economy. So that is something, if you're planning to sell in the short term, you really want to think about and talk with your advisors in advance. There's a few criteria. I'll mention them very briefly, but it needs to be a Canadian-controlled private company. So if you have non-resident investors, that could put you offside. So that's something you want to think about. The next criteria is the 2-year holding period. That's very black and white. You've held the shares of your company for 2 years, right? It's black and white. The other one is the asset test, and there's really 2 of them. So the government doesn't want to incentivize business owners to sell passive assets, which is like cash, marketable securities, or rental properties. So there's a test that if you look at the fair market value of the assets, 50% of them for the 2 years prior to the sale have to be attributable to active business, right? So I'm working with a client right now. They have a business worth $300,000. There's $700,000 of cash in the company, and there's been $700,000 of cash for the last few years. There's no way that they can qualify as is. The other one is that asset test of 50%. It goes up to 90% at the time of sale. So at the time of sale, 90% of the assets have to be attributable to active business. So obviously this is, $1 million tax-free at top marginal rates. That, to put a number to it, is a tax savings of $250,000, right? So this is something if you're planning to sell, you definitely want to set things up to qualify for this. A few other points about it is, if I sell my company and it's worth $2 million, well, if I'm a shareholder and my wife's a shareholder, well, then we could get $2 million tax-free, right? And then you sort of think of that concept of multiplying it. So you might think, well, could my kids get it? Could my parents get it? Could my nanny get it? So you could multiply it out. So the key thing is if your company's quite profitable, all this excess cash, you need to get it out of the company to keep it purified so you don't have any passive or bad assets. And so you can see the previous test, there's a lot of 2 years that are mentioned. So if there's a sale happening, either you have a good structure now or you really want to get ahead of it and get that structure set up and maybe move those passive assets out on a tax-deferred basis. That's probably enough there. I'll go to this chart here, and I'll just stand up for a second. This chart may not be appropriate for everyone, but you have a founder there, an individual. Maybe they started out as a proprietorship, and then at some point they made the decision that this company, it has legs, it's going to work, let's set up a corporation. So maybe at that time they have a parent company, an IP company, and that company holds the intellectual property, it holds the assets, and maybe it rents or licenses or leases those assets or IP down to an operating company. Maybe it also leases or rents, licenses them out to some third parties. I mean, we're seeing a lot of IT companies, they have often back offices in South Africa just because the labor's cheaper there. So we have a parent company, we have a family trust. Those can be great tools for multiplying that capital gains exemption of $1 million. So that's something to really think of. And very briefly, a family trust, you'd have a trustee who would probably be the founder, and they would control the assets and decide which of the beneficiaries get the cash. So that's a good structure to multiply. It's also a good structure to keep this company pure, right? So if operating company has $1 million of profit, it can move that $1 million up to parent company tax-free as a dividend. That parent company can also pay it to the family trust, and that same $1 million without any taxes can move to the holding company, right? So you have a great structure that keeps these companies pure of passive assets. And then the final point I'll make is, if you're a business owner and you think of RSPs, I often discourage business owners from considering RSPs because this is really your RSP, right? All your surplus goes up there, right? If you take out RSPs, it increases your personal tax. And a holding company has way more flexibility than RSPs for a number of reasons. I think that's it. So the final key points is, have a flexible structure that meets your current needs. Don't build a huge structure that maybe doesn't fit your needs. You can add that on later because there's a lot of maintenance costs to these complex structures. Insured tax planning is integrated. So, when you look at your corporation, your family trust, and your personal returns, you want to make sure you have the best result overall, right? You don't want to say, well, I don't want to pay any tax in the corporation, and then you're paying way too much tax personally. So you want to make sure everything's integrated. And then structures can grow and shrink. So get the right structure for your needs at the time.
Thanks, Walter. So Walter's essentially talked you through some of the different structures you may choose to leverage as you build out your business. What he's shown in that diagram is probably one of the more complex structures. So as a startup company, you're certainly not going to set that up from the get-go unless you're a second or third times founder, but good to be aware of so that as you grow your business and things get more complex, how can you structure things to protect your IP, to reduce your taxes, and ultimately structure your business for an exit. So I'm going to talk a little bit about the areas that I look at as a financial planner. Walter and I will have some disagreements at times as, I like RSPs sometimes for business owners. He doesn't like them, but it's okay, we're still friends, and that's why there's going to be grappling between your CPAs and your CFPs and ultimately the founder. The 4 things that a founder's wanting to do when they look to sell and structure their business is, first of all, maximize value. So when you sell your business, you want to get the most amount of money for it. And we're going to talk through which ways you could exit in a moment. The second component that you should care about is flexibility. So ensuring that your business, when you plan early, understanding what your trajectory might look like, so that you're not going to be pigeonholed into how much your business could sell for, whether or not you're qualified for the lifetime capital gains exemption, or whether or not your family could be involved in that transaction. Walter's talked through some of the tax implications. Ultimately, any technology business owner in Canada will have to make a trade-off at some point if they're planning to raise capital. Do they want to receive that $1 million tax-free capital gain? Or do they accept money from American investors to the point where they will no longer be a Canadian-controlled private corporation? There's no right or wrong here, and every business will have different goals, ambitions, and opportunities that develop as you build. But these are things that you'll want to consider as you first structure your business and then as you evolve your business over time. And then fourth is peace of mind. So as a founder, you likely have a lot of fires to put out on a regular basis. You have your team, you have to worry about sales, you have to build out your product, your pipeline. Business structure, legal ramifications, these sometimes fall down the priority list. So working with professionals that can help you make the right decisions can save you quite a bit of pain down the road, particularly if you have multiple founders or folks holding shares other than yourself, because then the decision making can be even more complex. So what are the 3 ways a founder could exit? Number 1 is going public. So going public means that you are essentially selling a good chunk of your company to investors. So a very profitable company that many of you in the room know, Shopify, this is how their founders essentially exited, by being able to take a lot of chips off the table and really increase their lifestyle expenses. Not necessarily for everyone, as going public does increase the level of scrutiny that your business is going to face, And so unless you really like attention and like being in the papers a lot, going public might not be the option for you. Second is selling to a strategic buyer. This is a very common exit approach, particularly for Vancouver-based technology companies. And I'll share some examples in a moment. The reason why this is a very common exit strategy is there are very large, typically US, sometimes global companies that are particularly looking for IP or aspects of their product lifecycle that they haven't been able to build themselves, but perhaps some people in this room have. So you found a particular niche, perhaps you worked at a company, saw there was a problem that you think is replicable, and you built your product out. Then Google sees what you've built and they say, well, we could compete with these guys, or we could just offer them $10 million. And for a company that generates billions of dollars in profit in a year, that's not a big deal for them. And so that's why you see some of these major tech companies acquiring smaller companies. It's easier for them to do it than try to build it themselves. And for us little Canadians, we're okay taking 10 million and living happily ever after. And so it's tended to work for them. You don't see as many companies that are born in Canada that stay in Canada longer term because of this, which I guess is unfortunate for the CRA with the SR&ED credits and all the benefits that we receive as early stage entrepreneurs. But nonetheless, that's what we've seen historically. And the third is management buyout. So depending on who you bring on as investors, perhaps they'll want to just take over more ownership of the company and generate profits on a long-term basis. Okay, so here's a few examples to consider. We've spoken briefly about Shopify. They went public in 2015. Their market cap is around 100 billion today. We've got Hootsuite. They actually raised quite a bit over the years and then eventually sold out to a private equity firm for around 750 million back in 2021. Bench, local Vancouver company as well. They were acquired by Square for 150 million. And then Beanworks, acquired by Sage for 113 million. So 2021, money was cheap. There was a lot of acquisitions, and as described, these are generally large companies based in the United States that are buying IP based in Canada and also buying a new revenue stream for their business. So I'm now going to just share a couple of strategies that you might consider for building and growing your wealth, whether or not you choose to exit or not. Now, both of these strategies will require collaboration with your accountant and legal team, but they're generally not for earlier stage entrepreneurs. So for those of you that are just getting started, this will be more of a FYI for the future, but there's certainly benefits to being a business owner in Canada and keeping a profitable business going long term. As Walter mentioned, tax rates in Canada, we pay very low corporate tax, particularly for small businesses, somewhere between 11 and 12%. Top marginal tax rate at 53. We want to avoid paying that on a regular basis if we can. So the individual pension plan, this is a structure that was meant to almost replace what was formerly a defined benefit pension plan. Business owners don't have perhaps as much RRSP room if they're receiving most of their income through dividend. However, if you do receive some of your money through salary, you have the ability to juice up the amount of RRSP room through the individual pension plan, sometimes by as much as 20 to 30%. So in Canada, Canadians, we receive 18% of our earned income added as RRSP. If you as a business owner set up an individual pension plan, you can have that actually juiced up considerably. Generally, these structures are not well suited for younger entrepreneurs, but between the ages of 40 and 60 would be an ideal time to evaluate these as a strategy. And if you've got at least 10 years left before you're planning to exit, either through sale or acquisition, that would be a good time to consider an individual pension plan. Another benefit, of course, is creditor proofing. So I'm sure everyone in the room, no one's going to be sued, but if that is something that you're concerned about, an individual pension plan does offer some additional creditor proofing outside of, say, what the RRSP does offer. You can also tax deduct many of the expenses that are associated with setting the plan up. These graphics are courtesy of my friends over at West Coast Actuaries. And this just goes to show you what some of the contribution differences might be if you were to leverage an individual pension plan versus simply an RRSP. Okay, so Ultimately, CRA wants to collect as much money in taxes as possible, but they want to incentivize entrepreneurs to hire more staff, which of course will generate them more profit. So that's why structures like the individual pension plan exist, is they do want to provide incentives to business owners to generate profit and keep employees here in Canada. Okay, the second strategy I'll touch on briefly today is the Insured Deposit Fund. Now, this is a structure for any business owners that have retained earnings in their corporation that they're not planning on reinvesting. Walter spoke about the benefits of keeping cash in your holding company rather than flowing it out and paying your personal tax rates. But then the question becomes, what about the taxes you pay on investments in that company on a long-term basis? You have the ability of setting up an insured deposit fund within your holding company and have the premiums paid by the company. This allows much of your investment dollars to be protected from paying income tax on a regular basis and could help avoid the grind down of the small business deduction, which can be considerable, and you might lose that low 11 or 12% tax rate. So this is a structure that several business owner clients of mine leverage in order to avoid paying the punitive taxes from investing passively within their holding company over a longer period of time. Ultimately, when you're structuring your business, you want to think about the complexity or simplicity of your business, as Walter mentioned. You want to stay simple when you're just getting started, prove out your MVP. When you know you've got the right sort of business, move towards a corporation, and then as you decide whether you're planning for a quick exit or whether you're planning to hold the business longer term, you may look to more complex structures in order to protect your IP, to qualify for your lifetime capital gains exemption, and to avoid punitive taxes on income from your corp over a longer period of time. So we'll move over to Q&A, but hopefully that wasn't too wordy for everyone in the room. And thank you very much to WeWork and Vancouver Tech Journal for having us host the topic today.
I had a question.
Shoot.
You talked about IPP and how you can set up the pension plan for individuals. What if you were hypothetically to transfer a portion of the shares to your parents, who would basically effectively take the pension? Is that kosher? Was that like halal?
I love that you're trying to help your parents out. So the question was, could we set up an IPP and have it be for the benefit of parents? To my knowledge, that's not possible. The big reason is whoever, I guess it depends if your parents are shareholders of your business, because the IPP needs to be set up for the benefit of the shareholder of the business. But there are other ways in which you can help your parents out, and I love that that's the focus. My wife is Filipina, and she's always thinking about ways in which to help parents, and I love that that's the question. But it depends on your business structure, I guess, is the best response to that. But there are ways you can help your parents out, particularly if they happen to be working for your company and have shares in your company. Sorry, can you speak up? I had a hard time. Yeah, Walter, you want to take that one?
Yeah, sure. Yeah, good question. So the question is, how can you go about setting up a corporation? There's really two ways. One is you could do it yourself. You can go online, pick a name, get it all set up. And the cost to do it yourself isn't too much, maybe $300 or $400. Probably the better route is to ask a lawyer to do it, just to set it up properly from the beginning. And really just at that time, think a little bit about the structure, the share structure, who the ultimate owners are, because it's often quite costly. You might do it yourself, and then to fix it soon after, it gets quite expensive. But generally a lawyer, if you give them pretty clear instructions, it's generally about $2,000 to incorporate a company.
Can I be
You could have a company where you're the sole shareholder and sole employee, yeah.
That's quite common. Although if you do bring partners in, it's recommended you get a shareholders agreement set up from the get-go. We're focusing specifically on the structures today, and so we're not lawyers, but we do work closely with lawyers generally to ensure that if you're opening up yourself or if you're doing it with professionals, it's set up the right way.
Yeah, you guys talked about, so there was one, you had structure of the trust. You had the holdco and opco, and the other one on the side was the company in South Africa. So let's say there was an entity in, for example, conveniently Dubai. So if that were to be the case, to set up that sort of structure, is that something you guys do here? Is that common for software businesses here? Like, how does that work with you guys?
I mean, that South African one, it's a little bit more advanced, but you would need someone in South Africa or Dubai to help you set that up and just make sure that through the cross-border transactions it works tax efficiently. Yeah, but you would need cross-border advice for that.
Just as well, I know several technology companies, they do hire outside of Canada, but sometimes they'll hire through contracting agencies that have a incorporation here in Canada. It's a bit of a gray area in the SR&ED perspective, because technically, yes, you're paying a contracting company here, but if the work's being done outside, that could potentially get you offside with CRA. So depending on if you're claiming for SR&ED or if you don't mind not claiming for SR&ED, then yeah, of course, hiring externally could save you some cash where the wages are a little lower.
We've used SR&ED before, and it's been great. The IRAP, do you guys work with the IRAP?
Yeah, several of my clients work with IRAP. You need to have a good relationship with your ITA, ultimately. If your ITA likes you, likes your business, believes in what you're doing, getting your first claim or reimbursement is the hardest, but once you can show growth from your original claim with IRAP and you have a good relationship with your ITA, you can get subsequent investments, if you will. Do you have one, Vince?
So for the tax benefits, especially like for Canadians, are those only applicable for like a citizenship Canadians, or if you already have a PR and those are included too?
A lot of those benefits, it's based on residency. So if you're a Canadian resident, you would have access to it. You'd be a shareholder of a Canadian-controlled private company. So it's based on residency.
Yeah, the government in Canada has created all these incentives to essentially try to create jobs in Canada. But as mentioned, with some of those exits that we've seen, a lot of times those companies will choose to retain their staff in Canada. Other times they'll let them go and move them south. However, since the dollar is so strong in the US compared to Canada, many of those companies are still retaining their employees here in Canada, which is beneficial for us in the short term. But I think the challenge that Canada is facing right now is how do you keep the IP in Canada? Because if all of these innovative companies create something of value and that just gets gobbled up by one of the FANGs, is that going to be beneficial for Canada long term if all of the companies that have any real IP of value are owned elsewhere? We can win on currency arbitrage in the short term and taxes are paid, but is that really good for the Canadian economy? Awesome. Well, we'll wrap up the formal portion of this event. Thank you very much, everyone, for coming today.
Thank you.